Michael Burry, who recently sold all but one of his holdings in U.S. stocks, believes that the economy is just getting started because Federal Reserve Chairman Jerome Powell underlined on August 26th that the central bank would keep aggressively raising interest rates to combat inflation. According to some experts, this monetary tightening will cause the economy to have a harsh landing or recession. How serious is the situation? Let's dig in and find out what Burry predicted. Call him Cassandra. Michael Burry is undoubtedly someone who backs up what he says, whether you like him or not. He practically sold every investment in his portfolio earlier this year. He also tweeted, "You have no idea how short I am," just last month. I am aware that it is simple to disregard Michael Burry's cautions, particularly in light of the recent 10% increase in the S&P 500 and the record-breaking $9.1 billion in sales that occurred on Black Friday. To us, that doesn't exactly sound like a recession. If Michael Burry has correctly predicted 2 out of the previous 10 crashes, you might agree with Elon Musk that he's a broken clock. Nevertheless, you might agree with Burry, who concedes that while his forecasts may come true someday, they may be made 1 or 2 years in advance. Actually, we disagree with Musk in this case. Many of us, in our opinion, may reflect on how the US government stifled supply when it shut down the entire economy. We all understand how they manipulated demand by printing and dispersing trillions of dollars. The best recipe for extreme widespread inflation, which is exactly what we got, is for supplies to collapse while demand soars. In retrospect, this catastrophe was inevitable. However, Michael Burry did plan for inflation, reopening, and stimulus on the horizon, even if not many people saw it coming. Before COVID, debt required $3 to expand GDP by $1, and the current inflationary crisis worsened the situation. 10 months prior to the stock market's high in February of 2011, he referred to it in that manner. With its contemporary monetary theory-influenced policies, the US government is encouraging inflation. Demand will increase thanks to billions more in stimulus spending and business reopenings while labor and supply chain costs soar. In our opinion, Michael Burry deserves much more credit for foreseeing how severe inflation would become, even though it was only temporary. We will utilize our tools to steer inflation back down to 2% if we notice that inflation expectations are rising or that inflation is headed in a direction that is considerably over our targets. It will ultimately be momentary. People must have faith in the central bank to act in this way, but they must also understand that we won't act in this way merely because it's the wrong course of action, as we honestly believe. When the economy starts to recover, this is a period that almost all forecasters firmly believe will see these things fall into place on their own. Just so everyone knows, we don't think the Federal Reserve should react to Michael Burry's remarks. But 9 months later, Jerome Powell didn't have to admit that he was mistaken about inflation, and he then began hiking interest rates at the quickest rate in over 4 decades, which he thinks will crush consumer and commercial spending. However, if the Fed had begun rising rates 9 months earlier, they could have at least softened some of the significant shocks they're currently delivering through the economy. We might eventually see a 50 basis point increase rather than a 75 basis point increase, but the committee might also increase its forecasts for the terminal rate, meaning interest rates would rise above what we anticipate in 2023. So far as inflation is concerned, Michael Burry was fairly accurate, but that is only one aspect of the picture. Michael Burry has also raised concerns about how well businesses would actually perform in the current economic climate and what investors should be willing to pay for those earnings. The predictions. Let me also go over those predictions with you. When adjusted for inflation, the S&P 500 fell by 25 to 26% in the first half of 2022, and the Nasdaq fell by 34 to 35%. Multiple compression was used there, and next up, earnings compression. When the first half of 2022 came to an end, that was from June 30. A month after that, he tweeted, "These earning reports and by Jove, the whole season has a last hurrah feel." Those events occurred during the second quarter's earnings season, which was quite good. Everyone dismissed Michael Burry's final tweet as just another hot take, but a little while later, he explained why he believed that the big tech companies at the top of the indices would report earnings that would fall short of expectations. They appeared to be all right, despite that fact. The business model transformation brought about by subscription software and hardware led to larger market multiples. However, this implies that numerous enterprises will later display weakness during a downturn. This should become more clear to parents as we approach the fourth quarter and finish the first quarter. Thus, corporations in the software and hardware industries frequently lock in huge sums of money all at once. Consider purchasing expensive equipment that's only updated occasionally or annual subscriptions. Most of those transactions are typically done near the end of the year. Christmas, New Year's, Cyber Monday, and Black Friday. These discounts significantly reduce a company's profit margins. Additionally, there will be significant future earnings loss for businesses that store and market physical items. Consider the large retailers like Amazon, Walmart, Target, and the rest that have stockpiling inventory for months. Companies desire to get rid of older products to make place for new ones because holding on to these stocks has expenses. Because of this, practically every firm offered greater Christmas discounts last year, including Amazon, which reduced their profit margins. Amazon also had 2 Prime Day promotions last year. Additionally, fiscal years typically end around this time in the business-to-business realm, and most businesses want to spend as much money as they can on items they are certain will require the following year. More so if there's a large discount. As a result, their budget is far more predictable, and the expenses are deducted from this year's earnings, reducing their tax liability. Michael Burry is highlighting that the stock market isn't accounting for poor year-end results caused by inflation and interest rates, or that sales of tangible items may be significantly less profitable due to higher discounts, only to keep inventory moving. Everyone is only interested in catchy headlines. Earnings for the current quarter and the first quarter of the following year, therefore, have the potential to drastically disappoint the stock market. And what's this? The prediction made by Michael Burry is already beginning to materialize. Big tech struggles with gloomy fourth quarter predictions and earnings. The market cap of Google, Amazon, and Microsoft fell by more than $350 billion following those earning releases, making it the worst week ever for meta platforms. Because the revenue growth was only 6% compared to 41% just 1 year ago, Google stock has fallen by over 20% since their last earnings call. This was Google's weakest period of growth in a decade, except in the early stages of the pandemic, when practically every company cut their ad spending, and their stock is still down more than 10% from their profits. Amazon's situation was far worse. Over the past quarter, their operational income decreased by virtually half, from $4.85 billion to $2.53 billion. Around the time of their earnings call, Amazon stock fell by about 30%, bringing their share price to levels lower than they were even before the pandemic started. Even no longer a trillion-dollar firm. Weak. Almost everywhere, Microsoft's growth rate fell. Compared to a year ago, the income from Office commercial products and cloud services increased by just 7% yearly. Both Microsoft Dynamics and Dynamics 365 saw a reduction in growth from the previous year. Additionally, Windows experienced a 15% decrease this year compared to a 10% growth last year. We should be asking why Microsoft stock recovered so quickly. Look, these businesses are among the best and most successful in the world. They're seated atop both the Nasdaq and the S&P 500. If they decline, the market will follow suit. Michael Burry expressed his opinions in general when these equities miraculously recovered some of their losses despite having low earning estimates by saying, "Did you all just mishear a death knell as a starting gun?" It should be obvious that Michael Burry is more than just a one-hit wonder who predicted the subprime mortgage crisis correctly in 2007 and 2008. Early in the previous year, he made accurate and very timely predictions about inflation. In our opinion, his forecasts for significant tech companies' earnings over the upcoming few quarters will hold true similarly. Because of this, we should at the very least give his stock market forecasts for the remainder of the year and into 2023 considerable consideration. According to Michael Burry, the stock market is still wildly inflated, and that much is obvious. Also keep in mind that the dot-com bubble, which peaked in March 2000 and burst in October 2002, took more than 2.5 years to fully burst. In addition, the S&P 500 had another 50% decline over 18 months during the Great Financial Crisis, with the bottom not reaching until March of 2000. As we enter the year 2023, Michael Burry believes that is exactly what might occur. The S&P 500 is currently trading at just under 4,000 points, and we're still more than a year away from the peak. In a tweet from earlier this year, Burry predicted that the S&P 500 would dip as low as 15% below the COVID low. That corresponds to a nominal PE ratio of roughly 9 or a show or PE ratio of around 16. We now have a nominal PE of 20 and a display PE of 29. The warning. Michael Burry predicts that during the next 3 months, the S&P 500 might decline by anywhere between 45 and 55% from its current level. Michael Burry had essentially sold every significant tech stake he had. He had platforms and tens of millions of dollars in businesses like Google, which he sold all of. He's backing up his claims with tens of millions of dollars. Therefore, it would be stupid for us to disregard his warnings for 2023 outright, just because he's the only one issuing them. This is the end of the video. If you want to learn more about what Michael Burry says, you may be interested in this one too. See you in the next video.